Hi everyone, today we'll be going over accounts October-November 2021, paper 3-1, question number 3. This is structured paper 3, which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes, and this question number 3 is of section A, which relates to financial accounting. So without any further delay, let's get started. Eunice and Malcolm had been in partnership for 5 years. They had agreed at the start that Eunice would provide most of the capital and Malcolm would provide labor by devoting his time to running the business. They therefore decided on a profit sharing ratio of 4:1. So they decided that Eunice would invest most of the capital and then Malcolm would invest in the form of labor. Now, for the first part of this question, we need to suggest 2 ways other than the profit sharing ratio in which a partnership could reward the introduction of capital and labor by partners. Alright, so if you remember our profit appropriation account, then for the capital, the partnership actually pays interest to the investors, right? So the partnership rewards the introduction of capital in the form of interest on capital. And for the labor by partners, there is obviously provision for salary. So partnership pays salaries in return for the labor by partners. Let's write it down. So for introduction of capital, that was interest on capital. And if we're talking about labor by partners, there is provision for partnership's salary. Alright, this concludes our first part. Now we can move to the second one. We are given additional information. So Eunice and Malcolm decided to retire and agreed to sell their business to FD Limited, receiving shares in return. So they will sell their partnership business and in return for the business, they would receive shares in FD Limited. For the second part, we need to state 3 differences between being a partner in a partnership and a shareholder in a limited company. Okay, so I'm just going to create some sort of table here. So this side we will write about being a partner in a partnership. And on this side we will write about being a shareholder in a limited company. Alright, if we're talking about being a partner definitely receives appropriation of profit, whereas shareholder, they receive dividend in order for their investment in the particular company. Let's write it down. So partner receive appropriation of profit and shareholders will receive dividends. Then secondly, partner in a partnership definitely has control of the company, whereas shareholders, they will have their voting rights. Let's write it down. Has control of the company, whereas shareholders has voting rights. Alright, lastly, in case of a partnership, death of a partner causes legal end of partnership, whereas in a limited company, death of shareholder does not affect legal existence of the company. Let's write it down. Death of partner causes legal end of partnership, whereas death of shareholders does not affect legal existence of the company. This concludes our second part. Now we can move to the third one. We are given additional information. So the partnership was sold on 31st December 2020, and the summarized statement of financial position of the partnership is also given. Then FD Limited took over all the assets and liabilities of the partnership, including the bank account. So they took over the non-current asset trade receivables bank as well as our liability, which is trade payables. Then the purchase consideration was 175,000. consisting of 140,000 ordinary shares of $1 each. So purchase consideration just means the amount paid to the partnership by FG Limited for the takeover. And this actually was funded by 140 ordinary shares of $1. So if the ordinary share is only of $1, then we actually need to pay the total amount of 175,000, right? So out of these, ordinary shares will actually fund 140,000 since we are giving out 140,000 ordinary shares at the rate of $1, right? Then there also is the remaining amount of 35,000. So this 35,000 will actually be funded by the share premium. All right, these were divided between Eunice and Malcolm on the basis of the balance on each partner's capital account on dissolution. So we actually need to figure out the capital balance for Eunice and Malcolm on dissolution. Okay, we need to calculate the number of shares received by each partner. Like I said before, this distribution of shares is on the basis of the balance on their respective capital accounts at the date of dissolution. So we actually need to figure out our capital balances on that particular date. In order to do so, we will be creating a capital account, but since we're given a vertical format, we will be writing down the capital account in a vertical format as well. So we will be starting with our opening balance, right? So we can just write it down as balance BD. And the opening balance will be the balance on the capital account in the above statement of financial position, which is given right here. For Eunice, that's going to be 80,000, and for Malcolm, that's 15,000. Let's write it down. So 80,000 and 15,000. Then since we're going to figure out the capital account balances on dissolution, we also need to adjust the current account balances to our capital account. So we can see that the current account balances for Eunice is 10,000. So this means that the capital account balance will actually be increased by 10,000. But for Malcolm, we are given the balance of 5,000 in a bracket, which means that this actually reduces the balance on Malcolm's capital account by 5,000. Let's write it down. We can just write it down as current account. And for Eunice, the current account balance should be increased by 10,000. So 10,000 is going to be positive. For Malcolm, we actually have to deduct the capital balances by 5,000. So that's 5,000, but in a bracket, indicating that this amount should be deducted. Now let's look at whether there was profit on dissolution or loss on dissolution. So profit or loss on dissolution can easily be figured out by subtracting the values of the assets and liabilities taken over from the purchase consideration. In this case, the purchase consideration is 175,000. So we're just going to subtract the assets taken over and add the liabilities taken over. So the assets taken over was 88,000. We need to subtract this. Then we have the trade receivables, 19,600. We need to subtract this as well. Then we have the bank balance of 100. Subtract this as well. But we need to add our liabilities taken over, which is the trade payables amounting to 7,700. All right, so this actually gives us the profit or the loss. If it is a positive amount, then that's the profit on dissolution. If it's a negative amount, that's a loss on dissolution. So that's just going to be 175,000 minus 88,000 minus 19,600 minus 100 plus 7,700, which gives a positive amount of 75,000. So this 75,000 is actually the profit on dissolution. And this profit on dissolution should be divided among the partners, who are Eunice and Malcolm, on their profit sharing ratio. So let's have a look at the above information. We were given the profit sharing ratio, and that was a 4:1. So out of 5 parts, 4 parts will belong to Eunice, whereas 1 part will belong to Malcolm. So we will divide this profit on that particular basis. All right, so out of 75,000, 4 out of 5 parts belong to Eunice, whereas out of 75,000, 1 out of 5 parts belong to Malcolm. So for Eunice, that's just going to be 75,000 times 4 by 5, which is 60,000. And for Malcolm, that's 75,000 times 1 by 5, which is 15,000. So these are the profits to be divided. And profit definitely increases the capital account balances, so we will be adding these two amounts. We can write it down as profit on dissolution. For Eunice, that's 60,000. And for Malcolm, that's 15,000. Now we can easily figure out the closing balances on the capital accounts at the date of dissolution. So that's balance CD. Okay, for Eunice, that's just going to be 80,000 plus 10,000 plus 60,000, which is 150,000. And for Malcolm, that's going to be 15,000 minus 5,000 plus 15,000, which is going to be 25,000. Now we will be dividing the ordinary shares of 140,000 among the partners Eunice and Malcolm on the basis of their closing capital balances. Okay, let's do that. So number of shares received. So the total share is 140,000 and we are dividing this on the basis of our closing capital balance. So let's figure the amount of ordinary shares for Eunice. That's just going to be 140,000 times 150,000 because that's his capital balance. Let's figure out the total capital balance first. So that's 150,000 plus 25,000, which gives 175,000. So out of 175,000, 150,000 is the capital balance of Eunice. So we just divide it with the total. Now this gives the number of shares received by Eunice to be 120,000. Let's write it down. We repeat the same process for Malcolm. So that's just going to be 140,000 times his closing capital balance, which is 25,000, out of the total capital balance of 175,000. So the amount of shares received by Malcolm is just going to be 140,000 times 25,000 divided by 175,000, which results in 20,000. All right, this concludes our third part. Now we can move to the fourth one. The profit for the partnership had been 30,000 a year, and FD Limited had a profit for the year of 600,000 in a year. On that date, the company had 1 million ordinary shares in issue. It was the policy of the company to have a dividend cover of 3 times. This means that out of the total profit, 1/3 of the profit was actually divided as dividends to the shareholders. So let's figure out the dividend amount. That's just going to be 1/3 of the profit, and we are given the profit to be 600,000. So that's 600,000 times 1 by 3, which means that the total dividend paid is just going to be 200,000. Okay, now we need to advise Malcolm whether or not he made the right decision when agreeing to sell the partnership. Support your answers with calculations. So we're only figuring out the decision for Malcolm. Now, the most basic thing that we can do is to compare the profit from partnership and the dividend received as a shareholder in FD Limited. Let's do that. First, let's calculate Malcolm's profit in partnership. Alright, we know that the total profit for the partnership had been 30,000 and the profit sharing ratio was 4:1, 4 for Eunice and 1 for Malcolm. So the profit share for Malcolm is just going to be 30,000 times 1 by 5, which is 6,000. So that's Malcolm's profit in partnership. That's the annual profit. Then we figure out Malcolm's dividend in FD Limited. We know that the total dividend was 200,000 and we know that the total ordinary share is 1 million. And we also figured out Malcolm's number of shares, which was 20,000. So now we can easily figure out the dividend for Malcolm, right? That's just unitary method. So the total dividend is 200,000. Then the dividend for one ordinary share is just going to be 200,000 divided by the total ordinary share that we have in FD Limited. And we are given the information that the total ordinary share is 1 million. So we can just divide it by 1 million. And in order to figure out Malcolm's particular dividend, we multiply this amount with Malcolm's amount of ordinary shares, which is 20,000. So that's 20,000. Now this gives Malcolm's dividend in FD Limited to be 200,000 divided by 1 million times 20,000, which is 4,000. So what we can see is that Malcolm's income has definitely decreased in becoming shareholder of FD Limited rather than staying as a partner in the partnership with Eunice, right? Let's write it down. Income will be lower. But we also know that the agreement for partnership was that Eunice would provide most of the capital, whereas Malcolm would provide labor. But in case of FD Limited, he's just staying as a shareholder and not doing any kind of labor and still receiving a dividend of 4,000. So that's a plus point for Malcolm in becoming a shareholder in FD Limited. Let's write it down. But he is no longer providing labor to the partnership, which means that he has free time now, right? And so is free to work and earn elsewhere. So this just means that he is receiving 4,000 for no particular labor, and Malcolm is still free to work somewhere else and earn other particular income, which might increase the total income as compared to the income he received from the partnership. And Malcolm is now a shareholder in a limited company rather than a partner in a partnership business. And if we're talking about partnership, the partners will have unlimited liabilities. But if we're talking about shareholders in a company, they will have a limited liability, which is a very good advantage. So Malcolm now has limited liability. Has limited liability now. All right. Then, like we said above in the differences between being a partner and being a shareholder, if we are a partner in a partnership, then we have more control of the partnership business. But if we're talking about shareholders, there are hundreds of shareholders. So definitely the control is being diluted now. So what we can say is that Malcolm has less control in FD Limited. As a shareholder of any company, Malcolm now has the possibility of capital growth in the future. So that's advantageous as well. Let's write it down. Has possibility of capital growth in the future. Now, if we are to advise whether or not Malcolm made the right decision when agreeing to sell the partnership based on these particular points, now I would definitely say that Malcolm made the right decision because he is receiving 4,000 in dividends without having to do any sort of labor, and he now also has limited liabilities, which is a very good thing for him. Let's write it down. So the decision is that Malcolm made the right decision when agreeing to sell the partnership. This concludes our fourth part. Now we can move to the fifth one. We are given additional information. FD Limited took over the non-current assets at a valuation of 130,000, and all other assets and liabilities were taken over at their book values. We now need to prepare the journal entry recording the acquisition of the partnership in the books of FD Limited. So that's debit side, that's credit side. And we're writing this journal entry from the point of view of FD Limited, right? And they are taking over the partnership, which means that they are taking over the assets. And there is definitely an increase in assets in the point of view from FD Limited. An increase in assets is always recorded in the debit side, which means that all the non-current assets, trade receivables, banks, and we might have goodwill as well because there was purchase consideration. So those will be recorded on the debit side. And the liabilities that were taken over, which was trade payables and the shares that were given in return to Eunice and Malcolm, will be recorded on the credit side. So that will be our journal entry. Let's write down our non-current assets value, which is 130,000. So assets is going to be recorded on the debit side, like I said before. We can write it down as tangible non-current assets because it does not account for goodwill. And this has a value of 130,000. And what we're told is all other assets were taken over at the net book value. So let's write down the assets name. They were trade receivables and bank. Let's have a look at the above information to find their values. So trade receivables had the value of 19,600 and bank had the value of 100. Let's write it down in our journal entry. That's 19,600 and 100. And there might be goodwill as well. So let's calculate goodwill. That is just going to be the difference between the purchase consideration and the value at which the assets were taken over plus the value at which the liabilities were taken over. So our purchase consideration is 175,000 and non-current assets were taken over at the value of 130,000. Then bank and trade receivables were taken over at their particular value, which is 19,600 and 100. Now we need to add the value at which the liabilities were taken over, and we only have one liability, which is of trade payables, amounting to 7,700. So we add that. And this will give our goodwill. So the goodwill is just going to be 175,000 minus 130,000 minus 19,600 minus 100 plus 7,700, which results in 33,000. So that's the goodwill value that we need to record in our journal entry. Let's do that. That's 33,000. Now we record the liabilities taken over on the credit side, and that was trade payables, which had the value of 7,700. Now we record the values given to Eunice and Malcolm for the acquisition of the partnership, and the values were given in the form of shares, right? And there was ordinary share and share premium. Let's write down the value for ordinary share. We give out 140,000 ordinary shares at the nominal rate of $1. So the value of the total ordinary share is also going to be 140,000. And we figured out share premium above. So let's have a look there. So total purchase consideration that we needed to pay to Eunice and Malcolm was 175,000. And out of this particular amount, 140,000 were given in the form of ordinary shares. So there is still the remaining amount of 35,000, which will be given in the form of share premium. So we need to record this value of 35,000 under the heading of share premium in our journal entry. Let's do that. So that's share premium with the value of 35,000. And in order to check whether our journal entry is correct, we can actually total the debit and the credit sides and see if they are the same. Let's do that. So for the debit side, that's going to be 130,000 plus 19,600 plus 100 plus 33,000, which results in 182,700. Then for the credit side, that's going to be 7,700 plus 140,000 plus 35,000, which again results in 182,700. So we can conclude that our journal entry is correct. And this concludes our fifth part as well as this particular question. If you found this video useful, make sure to like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.